Welcome back for our last segment in chapter 4. As we've kind of gone through the last two segments, looking at the price floor and the price ceiling. So price floor has to be set that's above the equilibrium price. It's going to generate initially some surpluses, and the price floor has to be set below the equilibrium price. It's going to initially generate some shortages, and they have to be set at those levels to ensure that they are effective. When we talked about the price floor, we're talking about the wage rate, the minimum wage rate. We also talked about a price floor for agricultural commodities. Price ceiling, some countries have it for gasoline, pharmaceuticals, other necessities. In the United States, you typically see the price ceiling set on rent-controlled properties that tries to ensure that you have necessities that are affordable to those individuals that need some help, and just supplying to either themselves or their families just the basic necessities to live. And so now in this last segment in chapter 4, we're going to talk about taxes. I'm not sure. I mean, ceilings and floors are kind of blunt, direct activities by government. Taxes are somewhat indirect attempts to impact the market, to drive operating revenue to not only federal government, but state government and local governments. Said, that authors talk about tax as an indirect mandatory payment to the government associated with some type of an economic activity, which makes sense. I hate April the 15th every year. It's the date, kind of that date that I circle on the calendar, and just when I look at my paycheck, just the amount of money that is taken out for state, federal, Social Security, Medicare, it's depressing, but it's part of the process of being a U.S. citizen, and it's part of our responsibility, and taxes are what they are. Everybody's familiar with the sales tax. Some states have a higher sales tax than others. Sales tax is basically, as you purchase a good or service, you're going to be taxed on the price or the total price of that good or service. Excise tax, that's somewhat unique. Most people don't think about it, an excise tax, in the way that they do a sales tax, or that they do an income tax. So you've got income tax, you've got federal, you've got state. When I was in graduate school in Columbus, I paid federal income tax, state of Ohio income tax, city of Columbus income tax, because I worked on campus at Ohio State. I had a county tax, Franklin County tax, and we lived in an area called Westerville. It was a suburb, and we had to have a local tax for the city of Westerville. All right, my paycheck when I was a graduate student, the total paycheck wasn't a lot to write home about to start with, but by the time we were taxed, I felt like we were just being taxed to death. And then, so you got sales tax, you've got income tax, and if you think about an excise tax is more based on a per unit basis. Per unit of a good or service sold. Let's state it that way. So excise tax, gasoline's got an excise tax. I think last time I looked, the federal tax on a gallon of gas was like 18 cents. I think the tax on the state of Tennessee on a gallon of gas is like 20 cents. So there's 30 cents, right there, 38 cents at that point, an excise tax that's built into the price that you don't really see. There's also what they call sin taxes. So it's the government that, if you consume alcohol, if you consume tobacco products, I think the book talks about strip clubs, kind of sin taxes that the government thinks that you shouldn't be participating in this. So they implement an excise tax on top of that to try to deter you from going down the wrong road. Another thing that most people don't think about, there's an excise tax on cell phone plans, kind of built into the price. And you go down through your bill, and there's an excise tax. It's kind of hidden in there because cell phone companies don't want you to know about it. But that excise tax is hidden in there to some degree. You've also got property taxes. If you own property, car, boat, home, it's rental, like a motor home. So any property that you own, and that's where a lot of governments generate their tax revenue, is through property tax. One thing that I hadn't thought too much about, and estate taxes depends on the estate that you're either going to pass down to your dependents or you're inheriting. So state taxes it really varies from one state to the next. And in the estate taxes, you need, you can sit down with your lawyer to try to figure out how to minimize those estate taxes. You've also got import taxes. If you drink French wine, there's an import tax on French wine built into the price of that bottle of wine. And the last thing that they talk about is a head tax. And I hadn't thought about a head tax in a long time, but it's kind of a per person tax. If you've ever gone, on a ferry ride from, let's say, out to, around New York City, they're charging you, used to be, I can't remember what the number was, but you paid a head tax for everybody that got on the ferry and everybody that got off the ferry. We lived in Southern California for a number of years. And between San Diego and Coronado Island, there was the Coronado Bridge. And if you drove over that bridge, and I think it was $1 per car. So each automobile was taxed $1 to go into Coronado. They weren't taxed coming back out, but to go into Coronado, there was $1 tax. And there was a head tax to go into Coronado. And what the authors have decided that it's, taxes are good. And I think most people would agree that a certain level of taxes would be good because governments use it for roads, for schools, for parks, security, sidewalks, street lights. And those are, if you remember going back to, maybe it was chapter 1, so there are scarce goods which are used in the production process. There are free goods, air, theoretically water, sand in the desert, considered a free good. And then there are public goods. And this is what we're talking about on taxation. Public goods are not necessarily excludable goods, but they are available to the public and they are driven and supported through a taxation, through some type of taxation. So we're talking about now taxation and public goods. And the authors decide they're going to use an excise tax to set the precedents, or kind of give you an example of what taxes will do to the prices and quantities as we're looking at supply and demand. So as I said, I can't remember what the price at the pump that I paid last time for gas here in Atlanta, but if I'm in Tennessee, I automatically know there's 20 cents, there's another 18 cents, another 38 cents coming out of that gallon of gas that's going to either the federal government or the state government. And what you will find is that most people don't understand that. It's what they call the price at the pump. It's built into that, it's hidden. You can get on Google, on the internet, and figure out what the excise tax is or what it costs you. But, and again, as I said, gasoline, diesel, cell phone, alcohol, cigarettes, all impacted by excise tax in one way or another. And what typically happens with an excise tax is it drives down the demand for that good or service. And it may, in some instances, drive down the production of that good or service. It discourages the activity being taxed, especially on those sin taxes. And as at one point, when the federal government was pushing for electronic vehicles here in the United States, they were talking about, I think behind closed doors, they were talking about maybe raising that excise tax, getting gasoline at a high enough level that it might incentivize individuals to move more toward the electronic or the EVs than they were. It moving that way in a slower pace. So I'm not sure whether those discussions are still going on now, but I could see increasing the excise tax, especially at the federal level, to incentivize people to go to electronic vehicles. And what typically happens with an excise tax is it is extracted from the seller. So I think the example they give in the book, it's a $2 excise tax. But if you think about the gas tax in the state of Tennessee, the seller, Racetrack, Love's, Pilot, whoever you're buying your gas from, is going to pay the government that 38 cents a gallon for that excise tax. And what typically happens is, and you can look at it when you're looking at the supply demand example in the textbook, is that even though the seller would like to pass on that total amount to the buyer, they can't necessarily pass that total amount on to the buyer. And it drives, they talk about it driving a wedge between the price the buyer pays and the price the seller pays. And it could be such a wedge that whatever that 38 cents is, that the buyer pays 19 cents of it. So it raises the price that you're going to pay as a buyer 19 cents, and the seller absorbs that 19 cents. So sellers will try to pass on as much as possible to the buyer until that point that the supply and demand curves start interacting in such a way that adjusts the price and adjusts the wedges, and that wedge between the buyer and the seller. And if you look at the formula, they had a formula set up in the book, and it basically said, the price the buyer pays equals the price the seller receives plus the tax. So the price at the pump that you see, and let's say regular gas now is $3.25, whatever the price is, that's not the price that the seller is going to receive, because the seller is going to have to pay that excise tax. So they're not going to receive that full price for that gallon of gasoline. And so what happens is, on an excise tax, because it increases the price of producing that good or service, you typically see supply moving to the left. You typically see demand moving to the left. So you've got your supply going this way, demand going this way, and what's going to happen? Quantity is going to automatically decrease, and the price is what's going to be dependent on which one has the largest magnitude of the move. Is it the supply? So is it the supply curve going to the left, or is it the demand curve going to the left as it sets that new equilibrium price? And so it's driving that wedge between the buyer and the seller. The buyer's going to pay a higher price, the seller's going to receive a lower price, and the government at the end of the day is unconcerned with who they extract that excise tax from, because the government's going to get, in the state of Tennessee, in their gallon of gas, they're going to get that 38 cents. And it's going to be up to the market to determine whether the buyer pays part of it and the seller pays, or which pays the most of that 38 cents, the buyer or the seller. And to kind of wind this section of chapter 4 up, we're going to talk about just why taxes. Actually, I'm not sure why the authors didn't kind of move the why taxes, that section they've got on that one page, why they didn't move it a little farther up in the chapter. But anyway, at least they're hitting on it. And why taxes? Well, one, Uncle Sam, your state government, your local governments, they need money to operate. Without tax revenue, they can't provide public goods, welfare programs, again, streets, highways, sidewalks, school systems. They can't provide any of those public goods without some operating funds. So that's probably the number one reason is why taxes exist, is to fund government programs, whether it's at the federal, state, or local level. And then the one I like best is the authors talk about paternalism. And I know the government, and in the infinite wisdom of all the individuals in, let's just take DC, the infinite wisdom of all the people in DC, they think they know what's best for me. They think they know better than I do what's best for me. And that's kind of this concept of paternalism. They are going to implement services, they're going to implement taxes on goods and services that I consume in such a way to try to either limit the supply or limit the demand on them. And that's where it goes back to the sin tax. So gas on alcohol, tobacco, gambling, excise tax on gasoline to help try to drive me more toward an electronic vehicle. That's where the paternalism comes in, and that's where the government thinks they know. The government thinks they know what's best for the consumer. They think they know better what's best for the consumer than the consumer knows for themselves. So that's paternalism. And then you've got improved market efficiency, improved social well-being and social welfare. We talked about price floors, price ceilings. You can have taxes instituted on polluters of water and air and production entities. So it's trying to make the markets more efficient is where the government implements taxes, and that's their concept of why taxes are important at that point. And then the last one, taxes are passed by legislators, and the authors make some comment about it. Legislators actually occasionally do what's in the best interest of their constituencies. I'm not sure they do it all the time, but I think there are some instances where they do what they think is best for their constituents. Goes back to kind of hand in hand that paternalism. And let's say a business wants to, let's say I'm a wine producer in Napa. I go to my legislature and senator, representative, and convince them to increase the import tax on French wine or German wine or Italian wine, something that's going to make me more competitive, more profitable in the market. And that's where they talk about rent seeking. And it's, you're trying to, in companies, if companies look at a normal profit, so you've got a normal profit, and anything that a company can extract above that normal profit, most economists refer to as an economic rent. So profits above a normal profit considered economic rents, and that's why I think they talk about it's a risk seeking, using the power of government for your economic advantage. So wine producer in California, talk to my legislature, let's up the import tax on, again, French, German, Italian wines, and it's going to make me more competitive, make my profits go up, and offset maybe some of the increased expenses that I've incurred because of weather and, infestation of insects or other issues that may be impacting the grape harvest or the grape production. That's going to wind things up for chapter 4. Hope you've enjoyed it. We will move on to chapter 5 shortly. Thanks for listening, and we'll talk to you soon.